Silver didn't break $100. It escaped it. For decades, that number wasn't just resistance on a chart. It was a psychological containment wall. The market hit it, hesitated, and backed away. Now it's gone. And once silver holds triple digits, the old rules stop working. Above $100, there's no trusted ceiling left, only price discovery. That's when the trade flips. Volatility doesn't scare money away anymore. It pulls money in. And here's what that means for you. The biggest risk is no longer buying too high. The biggest risk is waiting for $90 again and never seeing it. Because after a breakout like this, support forms fast, and hesitation can quietly price you out. But here's the part nobody is saying out loud. Even if the price is high, you may not be able to sell the silver you own. Because the real crisis isn't just price, it's liquidity. The world thinks this is a simple story. Silver crossed $100, so people got excited. But that's not what's actually happening. What's happening is a structural shift, and once you see it, you can't unsee it. The move above $100 isn't the end of a trend. It's the start of a different market, with different rules and different winners. Silver is now trading in triple digits, pushing into the 110 to 115 zone. And the speed of that move is the real warning sign. Because when prices rise slowly, you can plan. When prices rise fast, you don't get time. And the market knows it. That's why the psychology changes immediately. A former ceiling becomes a new floor, and every dip starts to feel like the last chance. So here's the question that reframes everything. Are you watching silver as a cheap metal that finally woke up? Or as an asset that just entered a phase where the exit might matter more than the entry? The strongest claim you need to understand right now is this. Silver isn't rising in a normal bull run. It's accelerating into a time-compressed melt-up, where the market starts moving faster than your ability to react. That's how people get trapped, not because they were wrong about direction, but because they assumed they'd have time to act later. Look at the velocity shift. In one stretch, moving from $20 to $30 took 145 days, but moving from $90 to $100 took just 10 days. That is not steady growth. That is the market entering a vertical phase where $10 swings stop being a monthly event and start becoming a weekly one, or worse, an overnight one. Now notice what's missing. There's no comfortable pause built into this structure. No slow retracement that invites late buyers in politely. Instead, the price starts behaving like it's chasing something, like it's trying to outrun scarcity, fear, and capital rotation all at once. But here's the part nobody wants to admit. In a melt-up, the market doesn't wait for you to feel ready. It forces decisions. And the next move isn't about whether silver can hit $150. It's about what happens when it tries to do it in weeks, not years. Now watch how fast this escalates. Because once silver starts moving like this, it doesn't just climb. It breaks the systems around it. The price isn't the only thing rising. Pressure is rising. Friction is rising. And the real damage begins where most people never look. The physical pipeline that turns silver on paper into cash in hand. This moment has a precedent, but not the kind people casually reference. It's not just a repeat of a past rally. It's the same pattern that appears when a market shifts from orderly price increases to disorderly demand. When the crowd starts buying because the price is rising, not because they understand the asset. The entire process normalizes something that should never feel normal. Empty inventories, widening spreads, and a scramble for anything that looks like a safe store of value. And the most dangerous part is how quickly everyone adapts to the chaos. A showcase with nothing left becomes normal. A massive premium becomes normal. Waiting weeks to settle a transaction becomes normal. But here's why that detail changes everything. If silver can go vertical in price, it can also go vertical in dysfunction. And the dysfunction always shows up first in the places that were built for slow markets. Here's the proof point that changes how you should see this market. The problem isn't demand. It's where demand can actually exit. As prices surged, refiners quietly stopped behaving like refiners. Products that used to move automatically, older alloyed silver, constitutional coins, sterling, suddenly slowed, stalled, or were refused outright. What used to clear in days now takes weeks, sometimes months. That creates a split reality. Pure modern bullion keeps moving. Everything else starts backing up. On paper, all silver rises together. In practice, only some of it stays liquid. Dealers feel this first because their business depends on speed. Cash in, metal out, repeat. When that loop breaks, they can't keep buying the way they used to, no matter how high the price goes. Notice the contradiction. Headlines say silver is soaring, but behind the counter, certain forms of silver are getting harder to move, not easier. That's the kind of mismatch that traps people. You think you're holding value, but you're actually holding delay. And once delay enters the system, behavior changes fast. Buyers get selective, sellers get surprised, and the market starts rewarding quality over quantity. Now, stack the pressure. Because the market isn't just running on price momentum anymore. It's running on bottlenecks, policy signals, and crowd psychology hitting at the same time. First, the velocity problem. When silver can jump $10 in days, every hesitation turns into regret, and every regret turns into panic buying. Second, the inventory problem. Dealers can't keep cases full because retail demand is stripping supply instantly, turning normal shopping into a scramble. Third, the liquidity problem. The moment certain forms of silver stop moving smoothly through refiners, the entire ecosystem starts protecting itself. Dealers tighten spreads, tighten buying rules, and start prioritizing the metal they can sell fastest. This is where the story stops being a rally and becomes a chain reaction. A wave of new buyers floods in because silver is in the headlines. That surge creates local scarcity. Scarcity drives premiums higher. Higher premiums validate the frenzy. And the frenzy accelerates the next leg up. But here's the part nobody wants to test. What happens when the system is moving too fast for the infrastructure underneath it? When pricing keeps rising, but real-world selling becomes slower, more selective, more conditional. Here's where it stops being abstract and starts touching your real life. Because when silver moves into triple digits, the impact isn't limited to investors and charts. It changes behavior on the street, at the counter, and inside households that don't even follow markets. You feel it in the way people talk about money. You feel it in the way prices stick. You feel it in the way trust starts to erode, quietly, month by month. A whole new wave of buyers is entering the space now, not because they studied fundamentals, but because they can see their purchasing power slipping. And when that happens, silver turns into a signal. People don't buy it because they understand it. They buy it because they don't trust what they're holding. That's why showcases can stay empty, even when dealers are buying aggressively. The metal doesn't sit, it disappears. And if you're trying to accumulate, that changes your reality fast. You're not just competing with other investors. You're competing with urgency, with panic, with people walking in and buying whatever's left because they don't want to be the last one holding paper. If this feels familiar, say so in the comments. Because the question isn't whether silver is too expensive. The question is what happens when the crowd decides it's never going back. This is the systemic mechanism most headlines will miss. Silver isn't just rising because people want it. It's rising because the incentives across the system are lining up in a way that removes resistance. When a market shifts into momentum, it needs one thing to keep accelerating: a lack of confident sellers. And right now, the sellers are disappearing. Because fear, scarcity, and institutional positioning are all pointing the same direction. The old story was always about suppression, about short pressure, about banks leaning on the market. But the structure has changed. Shorting has become socially and financially toxic. And that matters because it changes the shape of corrections. When there are fewer aggressive shorts willing to stand in front of the price, the violent downside smashes become harder to sustain. Dips still happen, but they get bought faster, and they don't last long enough for slow decision-making to work. And at the same time, the center of gravity is shifting. Western screen prices start lagging behind the real pull of physical demand elsewhere. When another market is willing to pay more, metal flows in that direction. That creates a hard floor under dips, because every weakness becomes an opportunity for someone else's stronger bid. Here's why that detail changes everything. If silver is being pulled higher by incentives and arbitrage, not just speculation, then waiting for normal behavior might be the most expensive mistake of the cycle. Now look ahead, because this story doesn't have just one ending. It splits into two paths, and your behavior depends on which path starts forming first. In the first path, silver stays in a melt-up rhythm. The move from $90 to $100 happening in 10 days becomes the template. $10 jumps stop feeling shocking and start feeling routine. Retail keeps chasing, premiums stay elevated, and every dip gets absorbed before it even feels like a dip. In that world, $150 doesn't arrive after a long debate. It arrives after a few violent weeks where the market barely pauses long enough for anyone to breathe. In the second path, silver holds above $100, but stops sprinting. The frenzy cools just enough for volatility to shake people out, but not enough to break the floor. The market starts grinding instead of exploding. Pullbacks happen, but they find support quickly because the underlying demand isn't gone. It's just less emotional. And here's the key. Both paths can look the same at first. The difference is speed. The difference is whether dips feel like relief or whether they feel like bait before the next surge. So, the next move is already forming. The question is whether this becomes a parabolic run or a high-altitude consolidation that sets up something even bigger. Here's the closing insight that makes the whole story click. Silver above $100 isn't just a price level. It's a signal that the market has stopped treating silver like a cheap metal and started treating it like a pressure valve, a release point for fear, scarcity, and distrust in the stability of money itself. And that's why the real risk in this cycle isn't simply, will it go up or down? The real risk is holding the wrong kind of silver, buying at the wrong moment, and assuming liquidity will always be there when you want it. Because when a market enters price discovery, it doesn't just reprice assets, it stress tests the infrastructure around them. If this turns into a melt-up, the upside can feel unreal. If it turns into a grind, the floor can stay higher than most people expect. And if the physical pipeline keeps breaking, you can end up wealthy on paper while stuck in real life. The winners won't just be the people who were bullish early. The winners will be the ones who understood the system underneath the chart. If you want the next layer, how smart money rotates out of silver and locks gains into stability, follow and subscribe. Because the next phase of this cycle won't be about buying. It'll be about knowing when the story changes.